Now, looking at the fixed strike vols, we did finish 0.5% higher on S&P, and vols were generally heading lower, but because of the massive bid that they caught on Friday, they finished the week higher. So you can see a very, very strong bid there to vol across the curve, particularly on the downside strike. So the at-the-monies weren't going crazy. Well, they were decent. They were up about a vol. But if you look at the upside, they were actually offered in November expiry. So they were down nearly half a vol on the upside area, like 4,500 and above. We know that area is an area where a lot of the street is long quite a lot of Vega through that JP Morgan trade in December. So that's the stuff that was for sale. But look at the downside. The 4,000 area was up like nearly 2 vols in November and generally in December and January as well. So very, very strong bid for downside. People coming in late in the week and just saying, mine protection. I can't afford to go into this weekend too exposed. It's coming up towards the end of the year. They probably chased the delta a little bit and got excited and positioned for the year-end rally, and then suddenly this kind of risk pops up on the radar. So rather than dump all their stocks, they're saying, okay, you know what? We're just going to hedge the downside tail here. We're going to keep our long exposure and protect ourselves for any tail risks to the downside. So that seems to be what's going on. Excuse me. The bid to skew has taken skew all the way to the 70th percentile in the US. So it is pretty pumped. But it's one of those things, right? You can't really sell these things naked. You can use them as a kind of barometer or indicator of just how stretched risk is and how stretched bearish sentiment maybe is. And that suggests to me that a bounce is very, very likely. But just selling this stuff naked is really not a thing that I would recommend. Okay.